This is the Chappell Real Estate Show, episode number 8.
Welcome to the Chappell Real Estate Show, your source for the latest real estate information so you can buy, sell, and invest with the best in Texas. Whether you're a first-time buyer, a current homeowner, or a seasoned investor, you've come to the right place. We're here to simplify all things real estate so you can achieve your goals of property ownership with your hosts, Daniel and Roger Chappell.
Good morning, listeners, and thank you for tuning into the Chappell Real Estate Show, your source for the latest information so that you can buy, sell, and invest with the best. I'm your host, Daniel Chappell, joined by my co-host today, Roger Chappell. And today we're going to have an extra special guest for you guys. So we've got Shelley Rodocker. She's a very respected mortgage lender in our area. She works with Fairway Independent Mortgage, and she is an absolute expert in the field. She has done miracles for some of our clients before in the past. So we're really excited to bring her to you guys and bring some really excellent information about the mortgage lending process to you guys today. So, hey, Dad, why don't you introduce Shelley for us and give her a good morning for us?
Hey, good morning, everybody. I want to welcome you to our 8th podcast and our first guest. Shelley Rodocker and I started working together almost 5 years ago now, not long after both of us got licensed. And we have done, I don't even know, I've lost track of how many deals we've done together over the years, but a number of them. And Shelley's always been one of these people that we can go to get the answers that we may need right away, whether she works with the client or not. She's always been extremely helpful to us and our team. So Shelley, we wanted to welcome you and thank you for joining us this morning.
Well, thank you so much for having me. I appreciate the opportunity.
Well, Shelley, sorry, go ahead, Dad.
Shelley, I was going to say, why don't you tell us just a little bit about yourself?
Well, so I have been in the mortgage industry for about 5 years. Prior to that, I sat on your side of the desk as a realtor, so I have some perspective there. I'm in the Georgetown, Texas area. I've been working here for about 4 out of the 5 years that I've had in the industry. And I love being here. I love what I do. I really enjoy helping clients, be able to realize their homeownership dreams and do whatever it takes in the process to get them to the closing table. So.
Awesome. So what kind of made you make that transition from real estate into mortgage lending? What was kind of the tipping point for you?
Well, so Roger's the master negotiator, okay? And that was always the thing that I just stripped my gears, kept me up at night trying to do those negotiations. It comes so natural for Roger. But so I had stepped away from the industry for just a little bit, and then I was going to get back in, and I thought, well, do I want to be a realtor? Do I want to be a lender? What do I want to do? And so I had been in the finance industry for a bit, and so I kind of married the two, my real estate experience plus my finance experience, and then it just all kind of came together in lending. And I love being able to work with one side of the table, that I can go to bat for them and do whatever it takes to get them from start to close, and not have to worry about the stuff that Roger's so good at. I can leave that to him.
Well, the biggest thing is to know to play to your strengths, right? So, I mean, hey, I think you found yourself a really great niche. You do very, very well in what you do. So that's awesome that you were able to find that segue into mortgage lending. So as you all know, every episode we give you guys what we like to call the Chappell Chunk. It's going to be your tip for the day. So Dad, why don't I go ahead and pass it over to you to give our listeners the Chappell Chunk?
Thanks, Daniel. So the Chappell Chunk today is very short, sweet, and simple. Find yourself a local lender. In today's market, our offers are so competitive that one of the things that a lot of listing agents are looking for is to make sure that they have that the buyer, the prospective buyer, has not only a local lender, but a local lender with a great reputation. So there are a number of lenders, just like real estate agents, there seems to be on every street corner. But for those of us that are professionals in our line of work, we know who can get the job done and who has a consistent track record of doing so. So with that said, obviously Shelley is a great partner of the Chappell Realty Group, but in addition to that, she's also a local realtor, a local mortgage lender that we know we can rely on, and that kind of helps give us a little bit of boost when we're submitting our offers.
awesome. Yeah, that is a great tip. I mean, in today's market, any little bit that you can do to kind of strengthen your offer helps. And I think definitely having a mortgage lender with a good reputation that knows how to get the deal done is extremely crucial in making sure that your offer looks a little bit stronger when presented. Well, thank you, Shelley, for providing us with the today's Chappell chunk. I know Roger delivered it, but it's information that we wouldn't have without your support. So thank you for sharing that with us. So now that that's out of the way, let's kind of jump into the nitty gritty of today's show. So, Shelley, let's assume we're talking to like a brand new first time home buyer, somebody who's completely inexperienced in the process. And let's kind of get them started in understanding what does it take to become a good borrower and be able to purchase a home.
Sure. Well, first thing we need to do is we've got to check some history things. We've got to, and history things are very important, as well as knowing what's going to be occurring, like job-wise, in the future. So, I want to make sure that your credit history is good. There are minimum credit scores based on whatever loan program it is that you qualify for. Right now, our minimum credit score is a 600 for FHA, and for conventional it's 620. USDA is 620, and VA is 600 as well. So we got to have your credit history good. And one thing that I like to do with first-time home buyers, sometimes they have no idea what their credit looks like. So I just say, well, let's just take a snapshot, look at this, and see if you're ready to buy now, or if we need to put a time frame on it. And then also with Fairway, we have some tools that we can use that can provide folks with a way to enhance their credit if there is stuff that needs to be done. So we look at that history, we look at your employment history. We need to have 2 years worth of work history. And that doesn't necessarily have to be in the same job. It's best if it's in the same industry, if there's some sort of segue from job to job. So we've got to have 2 years of history, we've got to have good credit history. And then we've got to just have the means to be able to afford what it is that you're trying to buy. We look at your debt to income ratios. And then also, there's we can get into the weeds with a lot of income stuff, with as far as like self-employed borrowers and such, because, there's some additional things that we have to look at with that. But those are the main things that we're going to look at: with credit history, employment history, and then if you're working in a job, is that job likely to continue, or is it something that's temporary? And we look at those sort of things.
Yeah, absolutely. Now I'm sure right now too that with with what's going on in the economy with COVID and everything else, that's something that you kind of see a little bit of a shift with a lot of people. I'm sure that's a common question with people getting laid off or changing careers or coming out of education and moving into careers. So yeah, thank you for kind of clearing that up. So we would assume that all of our listeners who are in our local area would give you a call if they're looking for mortgage lending assistance. But let's say, maybe they're not in our local area. How can they go about finding a good mortgage lender?
So you're going to want to, do your research. If you're working with a real estate professional, which I recommend, doing that as well right off the bat. But you're going to want to, that they'll usually have their list of folks that they have worked with in the past that have done a good job. So, and they'll kind of listen to you and kind of figure out what your needs are and what type of personality you have, and kind of fit you with the right one of their partners to work with. So if you start with a real estate professional, they can get you in 2 and 1. Also, read the reviews. Everybody out there, if they've been in the business and they've had any time in the business, they should have some reviews out there as well. And so you'll be able to tell, who has consistent reviews that say that they were helpful, they worked well with first-time home buyers, they, really helped me along in the process. I take those to heart because it's very important.
Great.
And also, find someone who, when you're looking for a lender as well, can they close me fast? What are their turn times? Is this something that I get into the process with them and 45 days later they're still delaying the process? Or if they tell me they can close me in 30 days, if they close me in 30 days. So that's important to know as well. And that's a lot of that's reputation with in the real estate industry as well.
Yeah, absolutely.
And I will say this, at Fairway, we do have some of the very fastest turn times. Our hiccup right now is only with appraisals. They're generally, that's going to be kind of the slowdown in the process right now, because it's just such a backlog of appraisal orders. They're the ones that are backed up. So we have to kind of look at our turn times based on that we do consistently make closing times.
So, Shelley, one of the things that just popped into my mind just a second ago is you mentioned appraisals. And what we noticed is like with the week that we had, everything was frozen, everything got pushed back a week, including surveys. Are you also seeing delays in closings due to surveys?
The surveys, yes, there have actually had one that we had to back off or back up because it was a new build and they have their particular survey company that they are using. So most of the time, or a good portion of the time, we don't have to have new appraisals ordered because they've gotten a lot more. We can use the existing appraisals many more times than not. So it's rare, but like with new builds and stuff right now, things are backed up with surveys too.
Yeah. Okay. All right.
Awesome. So after you get the verification of employment done from the lender side and you've gotten all the other pre-approval criteria kind of sorted out that we just discussed, let's kind of talk about what are some of the different loan options that are available to the borrowers. You mentioned VA, USDA, FHA, and conventional. So kind of let's dig a little bit deeper into those and let our listeners understand what's the difference between all those loan programs.
Sure. So let's start with the conventional. Conventional is going to be your, just pretty much run of the mill loan type that you can have is it's probably one of the easier ones to qualify for, but it's got several different options as far as for down payment. If you're a first time home buyer, you can get away with 3% down payment if you can qualify. Then you can do anywhere up to whatever you want to put up to. You'll have mortgage insurance involved until you get up to the 20%. And conventional, you're allowed to use primary residence. You can buy a second home using conventional loan or investment property. That's the only type of loan that you can do if you're going to do something other than a primary residence. All the government products, VA, FHA, USDA, all of those require those to be your primary residence. So the minimum down payment requirement, like I said, first time home buyer is 3%. If you already currently own a home, it's 5%. If you're going to buy an investment property and it's just a single family unit, that's 15% down. FHA, that's a great program. The credit score requirement is 600, and the minimum down payment for that is 3.5%. You do have mortgage insurance with that for the life of the loan. It's not something that goes away, but it's great for first time home buyers because the down payment limits are low. You don't have to have that much down. USDA is a program that is based on income. There's income limits, there's geographical limits, and it's a little bit stricter on the credit. And also you can't have a lot of money saved up as well with USDA. But it's zero down. The mortgage insurance on that it's considered an annual fee. It's not really actually mortgage insurance, and it's pretty low too. So if you can qualify for USDA, it is a fabulous program because it's zero down. And then you've got your VA program for folks who have either been in the service or they are currently serving. And there's a lot of requirements for that as far as your military service, and we could get into the weeds with that, but if you have a DD 214 and you have VA benefits available to you, more than likely you have availability to use the home program as well, and that's a zero down. There is no mortgage insurance with that, and the debt to income ratios that we can use on VA are a little bit higher, so you can get a little bit higher of a price point, so it's a little bit easier to qualify for as well. We want to make sure that we take very good care of our current service members and also veterans as well with that. And the minimum credit score requirements for VA 600 right now, and this varies from lender to lender, because there are some folks that have different overlays that say, we will only, lend to this credit score or whatever, but with Fairway it's 600 for VA, 600 for FHA, 620 for USDA, and 620 for conventional loans. So, and pretty much across the board, you got to have your 2 years in your employment history. You've got to have, good credit history, but there's some things in the programs that allow for some variances depending on, a person's situation. Best thing to do is get with, with someone in the lending industry and ask all the questions. Someone that's, that's going to take their time with you to answer, to figure out your situation and look at each one of the programs to determine which one is best for you. Now, also on top of that, there's also some different down payment assistance programs that we have available to us as well. Some of those you have to be a first-time home buyer for. Some of them you don't have to be a first-time home buyer for, but there are income requirements based on geography. Every county has a different income limit. But those can provide what's, the minimum down payment. They can help with that. There's different levels of assistance. And so they have different interest rates attached to them. But if you can qualify for those programs, the minimum credit score for those is a 620. So you can qualify for those. Sometimes you can get in the home, even if there's a required down payment for the loan program, you can get in with zero down or close to zero down.
Wow.
So Shelley, I have two quick questions for you. First of all, if you could explain to us what mortgage insurance is. And then secondly, and I already know the answer to this, but I'd like our listeners to try to find out too. For the various loan programs, and I'm thinking specifically of USDA, isn't it true that the property also has to qualify for that loan and not just the individual?
Yes. So for the second question, since just asked that one. So for that question, yes. For USDA, it has to be located in a geographical area that is approved by USDA. It's a rural housing program. And so you can look at it by address. There's a website that you're looked at by address to determine if that particular property is located inside of a USDA approved area. And it's basically, in a nutshell, it's areas with populations of less than 50,000. And those are the property areas that are the USDA eligible. Yes. So, and the first question you asked me again.
Mortgage insurance. Mortgage insurance. Can you explain to us what that is?
So anytime you borrow money and you're putting down less than 20% with either FHA or conventional. FHA, it's not private mortgage insurance, it's just mortgage insurance. And that stays the life of the loan. It's a fixed percentage that stays the life of the loan with the FHA mortgage. With conventional, anytime you put down less than 20%, there is mortgage insurance involved. It's based on your credit score. So if you've got a higher credit score, your mortgage insurance is going to be less than if you have a lower credit score. It's based on risk. So essentially, the more you put down, the less your mortgage insurance is. And it's really and truly borrower specific because it's going to look at things like your debt to income ratios. It's going to look at your credit score. It's going to look at, your credit history. It just looks at so many things. And then the amount of, down payment that you're putting down. So it's very subjective per borrower.
So basically, if I understand you correctly, as long as a person puts down more than 20% or more, they do not have to pay mortgage insurance. But if they put down anything less than that, they're going to be paying for mortgage insurance under the FHA or conventional loans. However, USDA and VA loans do not require that. Is that correct?
So VA loans have no mortgage insurance whatsoever. There is a fund. If you have 0% of disability, there is a funding fee that's involved that's somewhat like mortgage insurance, but it's something that's tacked onto the loan. It's not something that you pay for on a monthly basis. USDA does not have mortgage insurance, but they have got an annual fee, and that annual fee is 0.35% of your loan amount. And so it's very minimal. It's not called mortgage insurance. It's called their annual fee, but it's kind of like their version of mortgage insurance, if that makes sense.
Yes.
But technically mortgage insurance.
So what does mortgage insurance protect against? Insurance, typically it's implied that it's for the benefit of the buyer. So I want our listeners to kind of understand, what does that mortgage insurance really do?
So the mortgage insurance is not protecting the borrower. It's actually protecting the lender. Because if you're putting down less than 20%, that's considered a layer of risk. And so the mortgage insurance insures the mortgage company that those payments are going to be, made on time. The mortgage is going to, get paid and carried out as intended. And so the less amount of skin you've got in the game, the more risk it's considered. And so that mortgage insurance does protect the lender, not the borrower.
Right. Yeah, that's what I wanted to touch on, just so that everybody understands that the reason why it fluctuates so much from borrower to borrower is because of the amount of risk that the borrower is actually putting up. And that's why it actually plays a factor into how much that mortgage insurance will actually end up costing you. And there was one other thing that I wanted to kind of touch on, because it's something that comes up pretty commonly, especially with buyers in kind of my age pool in the early 20s, late 20s area, is student loans. How do student loans impact a borrower's ability to qualify for a loan? I know there's a lot of misconceptions about they don't count against you or they do count against you. So kind of clear that up for our listeners, please.
Sure. Well, it actually varies completely by loan program that you use. Every loan program has a different rule for student loans. Right now, most student loans are, so when we open up a credit report, it says zero payment. So if somebody can give us a documentation that it is zero payment, on some loan programs that work, some loan programs we still have to count a payment in there. So looking at FHA, pretty straightforward. It's like kind of unbendable on that. If you're doing an FHA loan, unless the payment indicates otherwise in a higher way, we have to count 1% of the balance for every student loan that you've got. 1% of that goes in counting into your debt to income ratios. If we're locking you with conventional, two different ways we can go with conventional. One's Fannie Mae, one's Freddie Mac. There's just the two different the government institutions that are doing conventional loans. Fannie Mae, there's different rules with that. Sometimes we can count a zero payment if there's documentation. If there's no documentation, there's no payment, we count 1%. If the payment on the credit report does not indicate higher. With Freddie Mac, we count 0.5%. With USDA, we count 0.5%. And then with VA, it's a little bit different. It's a little bit different of a formula with that as well. And sometimes, like if your payments are deferred, with some programs, we can not count the payments. With some other programs, we still have to count the payments. So it's very, it's pretty complicated. It's one of those kind of things, whenever I get a credit report that's got a lot of student loans, my wheels immediately start turning. Okay, which way are we going to be able to go with this to be able to get you the best loan program? Because, either we have to really worry about the debt to income levels, or we can say, oh, well, we can be flexible with it. But it's one of those variables that does play a factor into how much you can qualify for, definitely.
Yeah, absolutely. Awesome. Well, thank you for all of that. So something else that, a lot of people tend to wonder about is like first-time buyer assistance, special loan types, and things of that nature. So, I know some of the loan types that we've discussed already are a little bit more beneficial for first-time home buyers, but what are some of the other programs, I guess, that first-time home buyers can take advantage of?
Sure. So with the first-time home buyer programs, so a lot or most of them are income specific. So you have to be under specific income level for the majority of them. The one loan program that's available to everyone, depending on credit score and such, is if you're going conventional, you only have to put 3% down. So it limits what your required investment is on the property if you're going conventional. So that's pretty much across the board. As long as you can qualify for a credit score and your all the risk levels, then that's something that's available to everyone, no matter what your income is. Now, the other programs, the mortgage credit certificate, that is a program that actually helps save you on your taxes. It's on our end of it, we can use it to kind of boost your income for qualification, but and that's because you're saving money every year for taxes. It helps you take advantage of more interest savings on your taxes at the end of the year. And something I encourage you to Google, look at mortgage credit certificates, see if it's something that you want to do. There's fees associated with it, but it has income limits. And that's by county. So depending on what county you're purchasing in, you have to, if you are the income limit for that, then you can potentially qualify for the mortgage credit certificate. It takes a look at all household income, and it makes sure that you haven't owned property for the last 3 years. That's qualifications for that. Then there's other down payment assistance programs that are also first-time home buyer as well. And some of those are Texas Department of Housing Association, TDHCA, has some really good programs. The interest rates are pretty darn low, and second lien programs for first-time home buyers. And then, so those are the main things for first-time home buyers. If you make a ton of money, and you're probably not going to qualify for a lot of the first-time homebuyer programs, other than being able to put down less on a conventional loan. So I know a lot of people think that there's just programs out there that will just, just give you money no matter what because you're a first-time home buyer. And, yes, but there are some, stipulations for that. And the credit score, minimum credit scores is 620 for those programs, pretty much across the board.
Gotcha.
So thanks, Shelley. That's been extremely helpful. But I kind of wanted to transition over to one other thing that I get the questions for all the time, and I know you as a lender get them probably a heck of a lot more than I do. So as a buyer, and it doesn't matter if it's first time buyer or 50th time buyer, it seems like the more they buy, the more complicated this process becomes, to be honest with you. What documentation is going to be required by the buyer? Because I know it's not just a couple of little documents and an ID card. There's got to be more to it than that. Can you explain to us some of that?
Oh, sure. Yes. So that's the most fun part of my job. Let me tell you, asking for that documentation, because everyone's just so ready to just open it all up and load it up. And on the back of my card, I've got my little list. So it's always going to be a photo ID and a social security card. If you don't have a social security card, we can always order verification. So that's not a stopper. Then we're going to have 2 months worth of bank statements. And those bank statements need to be for, the earnest money funds that you're going to be putting down on the purchase, and then also for any down payment so if you're want to make this simple, have all of your down payment money come from one source, because if you have 14 different accounts and you're transferring money between those accounts and you're going to use all that stuff, I'm going to have all 14 of those accounts and trace all the transfers. So that's not as much fun as it sounds. But so we've got photo ID, social security card, 2 months. I need to have 2 years worth of your W-2s and 1099s. And if you're doing a down payment assistance program, I have to have 3 years worth, because they've got to prove that, you haven't been a homeowner for 3 years. So we have to have 3 years of that. We've got to have 3 years worth of tax returns if you are a first-time home buyer, 2 years worth of tax returns if you are just not qualifying for one of those programs. Then we've got to have copies of your earnest money, copies of your whenever that flows through your account, and we've got to know who your insurance can be. On top of that, that's like baseline, basically those things that we have to have. Then if you own property, then there's things that we'll need for that, like mortgage statements and things like that. If you have rental property, we got to have copies of lease and stuff. So depending on what your situation is, the documentation level could be, pretty simple, or it could get pretty complex. But we start out with those first, basic things: 2 months bank statements, photo ID, social security card, 2 years worth of W-2s and your tax returns. So, and I really do try to keep it as simple as I possibly can. So if someone starts unloading a very complicated situation, I try to unpack that back and say, wait, hang on. Can we do without this portion of your income on the qualification? If we can, that's going to save us a lot of documentation and a lot of heartache with all of that, trying to get that through underwriting. I want to make it as simple as I can for the client, then for my team processing it, the underwriter going through everything, and then getting you to the closing table. So just try to keep it as simple as possible. It doesn't always seem like it. It always seems like there's a lot more to it than simple. Nobody looks at this, at the stuff that I say, and say, oh, that was so easy. Because there's usually something, like if you have just for example, so like if you have a bank, we present a bank statement. So we've only asked for your 2 months of bank statements, but then we see that you deposited, $15,000 from something, and, it could have been from the sale of the car or whatever. All of a sudden now we need documentation for that, because it's just the requirements of the industry. We have to be able to document, large things coming in and out of the account. So yeah, it's fun stuff. It's the most fun part of my day.
So I have another quick question for you, because I know there's got to be something out there that pops up for you as a lender on a regular basis that just kind of drives you nuts. Not necessarily drives you nuts, but kind of like, there's got to be something. What is it? What is that thing?
I guess it's whenever you kind of almost want to look at your lender like you do in a like a doctor or whatever. You want to tell them everything and then let the lender sort out. I don't like to find out about something that I didn't know about. Like, it's the large deposits really that get me. No. This is I just thought cash for your earnest money. That's the big thing. And they're like, but wait, I got a cashier's check for that. I put down $5,000 because of cashier's check, but well, where did that money come from? I have to be able to trace that. And so if you've gotten a cashier's check for your earnest money, I all of a sudden, and it was from cash, not something out of an account. That's perfectly allowed. If you pulled money out of your account, we can document, that's great. But if you went to your safe and you pulled out $5,000 of cash, and then you went to go get a cashier's check, all of a sudden that's $5,000 I can't count in the transaction. And that could mean you don't qualify because we needed that cash for either reserves or just to show that you had enough money to come to the table with. So yeah, that's really fun.
Can you explain to me what loan to value ratio means? I know that's kind of random and out there, but I'm just curious.
Sure. So loan to value. Loan to value means what the house is worth versus what you're borrowing. So when you start out in a transaction, the loan to value is based on the sales price. So if you've got a sales price of 400,000 and your loan amount is 320, that's an 80% loan to value. Okay. And that stands as long as throughout the process, when you get the appraisal, you get that appraisal in, and that appraisal is either at or higher than the sales price, same loan to value. When the loan to value changes is, say you under contract for 400, your appraisal comes in at 350. Now your new loan to value is based on the 350 because that's under the sales price. So then now all of a sudden your $320,000 loan to the $350,000 value is not an 80-20 value anymore. So if you want to keep that 80-20 value, you've got to go down in loan amount, which means you've got to bring more cash to closing if that's the case. Or you just adjust your loan to value down to 5% or 10% or whatever the case may be, whatever you can afford. But that's loan to value, sales price to start with, and then if the appraisal comes in at or above, stays. If the appraisal comes in lower, then your loan to value then becomes whatever your appraised value is. And people need to keep that into consideration whenever they're talking about going over asking, in this crazy market that we're in, because that could end up hurting you if you don't have the what you need to take to keep your loan to value or adjust it depending on your situation. It's important.
Yeah, absolutely. So I kind of want to back it up just for a second before we move on. And we talked about documentation. How does the documentation differ for somebody who's, say, W-2 versus somebody who's like us, self-employed, 1099? There's a lot of gig workers out there nowadays as well. So how does that differ in terms of documentation and the complication of the process?
Sure. So if you're a straight W-2 employee and I'm trying to, get the information for your income, so I'm going to look at your W-2 situation, and I'm going to look at your pay stubs, and that's going to give me the whole picture of what I need for the documentation I need for your income. If you are a self-employed borrower, your income is determined by how you file your taxes. So if you claim, a lot of deductions on your tax returns, and that brings your, taxable income way down, then I've got to use what you do on your tax returns. So that's very important. So if you're self-employed, we've got to have tax returns. We've got to have, for 2 years, we've got to have a profit and loss. We have to have, if you have your own business, we've got to have business bank statements for 3 months. And we have to make sure, especially during these COVID years or year, I don't want to drag it out. We also have to make sure that where you were at for income for 2019, like 2020 didn't take a nosedive, because then all of a sudden that income doesn't look stable. So there's a lot of considerations. The profit and loss has to be very consistent with what you've done in the past. So those kinds of things we just have to prove that your income is stable, and just takes a little bit more to it. One thing I didn't say on the required documentation was pay stubs. That is something else we have to have, 30 days worth of pay stubs. I apologize, I left that off. So that's on there too.
Awesome, thank you.
Yeah, so so if you're just W-2, it's pretty straightforward. We just have to make sure that your pay stub income matches what your W-2 is and what we show in the file for what you're going to have, that we can qualify you on.
Gotcha. Okay. So moving on, now let's kind of talk about, this is something that we hear horror stories about all the time. I'm sure you deal with it a lot more than what we hear about it, but let's talk about some of the things. What are some of we'll talk diligence and discipline. What are some of the should do's and absolutely should not do's as a borrower when you're in the process under contract on a home and working on getting a loan?
Sure. So um, let's start with the should not do's. You should not have any more credit inquiries. Do not go out and buy furniture while you're in the process, or even go apply for a Kohl's card. We don't want to do that while you're in the process, because if you have a credit inquiry, then now we've got to look at all that stuff. So you don't want to open up any new credit. You don't want to be transferring large sums of money in between bank accounts, because that's whenever we get into some documentation issues as well, things that people don't want to explain. You don't want to take in any cash deposits. You want to make sure that you don't want to, if your income is based on, a variable income especially, you do not want to just take off vacation or something and as you're shopping for a home and your income all of a sudden drops. So you want your income to stay consistent. You don't want large in and out deposits. You don't want to no new credit, no new liabilities. Those are the main things. And then make sure that you are you're keeping your balances in your bank as high as they can be. Do not have any NSF fees. That's a big thing that can throw a hiccup in the process. Just want to be consistent. You want to be consistent with making sure that your reserves stay up, your credit stays good, and you're not increasing your liabilities. Those are the main issues.
Yeah, so patience. I can tell you right off the top of my head, the last probably 4 or 5 loans that I've had, especially with regards to new buyers, patience is one of the things that is a tough deal for a lot of buyers. And, I know it's frustrating once a person has applied for a loan, or a couple, and here they are anticipating purchasing their home, and here we are 3 or 4 days away from closing, and all of a sudden the underwriter says, and this is usually transferred through the loan officer, but the underwriter says, we can't approve the loan based on XYZ. Now, I have heard this literally the last 3 first-time buyers that I dealt with. We had exactly that phrase come back to us. Underwriting can't approve the loan based on XYZ. And every single time, XYZ was nothing more than they needed to get another document. And with that particular document or letter of explanation, it makes that hiccup or that problem the underwriting discovered basically go away, because there's an explanation for it. So, what do you feel, or what is your take on buyers and their frustrations regarding this process, specifically when it comes from underwriting and we're just days away from closing?
Yeah. So most of the time, or a lot of the time, that stuff could be avoided like 3 or 4 days before closing if the loan officer has done their due diligence and getting everything up front. Sometimes it's unavoidable though, because we have to get things in the process, such as a bank statement showing that your earnest money has cleared out of the account. And so sometimes getting that additional bank statement will bring up a question or something that we have to do. Sometimes these things are, somewhat unavoidable because, things come up in pay stubs or whatever. I say be patient with the process. If your loan officer asks you for something, be very quick to respond and get it to them, so as to not delay the process any further. And just understand that the loan officer wants nothing more than, and the underwriter really wants nothing more than to get you through the process and get you into your home. They're not trying to throw up a hard stop to say, we don't want you to have this house. It's just a matter of, we know that on the back end of this, if we don't get this documentation, that on the back end of this is going to could come back to bite us. And underwriters have, they've got to prove everything. Everything has to be in writing. And so whether or not it comes across as if well, this should be explained by this, well, maybe, but there's specific rules for the documentation that's needed depending on the situation. And that underwriter has to be able to have that particular document that answers that particular issue. And once it's provided, it's done, and it's over. There's just a lot of documentation that goes into loaning. And so we're loaning hundreds of thousands of dollars. And so, if you look at it that way, you're getting, two or three, $400,000 from the lender. That lender has to do their due diligence to make sure that everything is buttoned up and the loan is going to be, you're going to be able to have the ability to repay. And we've done our due diligence, getting everything we need to satisfy, ultimately the investor that's going to take a look at it after everything's closed. So just be patient and work with your loan officer to get those documents, even though it might seem excessive. It's just what's required of the process, unfortunately.
Okay.
Yeah. Thanks for that explanation.
Awesome. Well,
I wish it were easier. Sometimes it's not.
No, we totally understand. We understand being in the business, of course. So hopefully today's episode was good for our listeners, that they got some good information to kind of understand what the process is like. So now we want to kind of take a few minutes, give our listeners an opportunity to get to know Shelley as a person. So we've got a few questions for you. Are you ready?
Yes.
All right. So Shelley, what was the first concert that you ever went to?
Oh, goodness gracious. I think it was John Schneider and Alabama at the Frank Erwin Center. And that was when John Schneider was like in between Dukes of Hazzards and whatever it is that he's doing now. He was just kind of like he was the opening act for Alabama. Yeah.
Wow, that's really cool. Awesome. So what is one of your favorite hobby or hobbies?
I'm a worker. I don't have much time for a whole lot of hobbies. I do like to spend time outdoors, walking when the weather is beautiful. And I'm such a Georgetown fanatic that I spend a lot of time walking the square and going in and out of the shops and trying to support local. To me, that's kind of a passion of mine, because I love to see this downtown here in Georgetown thrive. And so that's something that's very important to me. I love to talk to people about, Georgetown and, all the things of it. I do a lot of volunteering for the city as well, too. I was on the Main Street Advisory Board, and, we've do things to, raise money for downtown. So that I guess, I don't know, is that a hobby? It's just something I like to do. So
I would call it a hobby. And you know what? I think that'd make for a great topic on a future episode. We'll have to have you on for Georgetown happenings or something like that to let our listeners know what's so great about Georgetown, right?
Oh, I do. We got more than 40 minutes for that one, right?
Oh, we'll have to make sure of it, won't we? So Shelley, who is the most memorable person that you've ever met?
Most memorable person that I have ever met. Okay, this is going to be really silly and dumb. But so whenever I was a teenager, one of my best friends used to take me to wrestling. I don't know if you know the Von Erich brothers, but we got to go backstage as a junior hire, go backstage with and meet these wrestlers. I mean, I haven't lived that, interesting of a life, but that was probably the most fun that I got to get autograph pictures and stuff like that. I don't know. That was fun for me. So I will say this, I do have some notoriety as far as like who I'm related to, and that is Johnny Cash. So my grandfather was June Carter Cash's second cousin. So I claim relation to Johnny Cash.
That is really, really cool. I'm a big fan of Johnny Cash.
Yeah, never met him, but I am somewhat related.
Hey, well, that's still really cool, right? So what is the most exotic place that you've ever traveled to?
I haven't done a lot of traveling, but I think the most enjoyable place that I ever traveled to was Washington, D.C. I did that several years ago and got to see all the Mall of America, which I was almost confused about, like, where's the mall? Did figure that out, though, while I was there. Got to see all of the museums and stuff like that. It was really cool to see all the history and it's a great place to visit if you haven't ever. You see all these things on the news, and then you go there and you're like, oh wow, this is really as as beautiful and interesting and historical as you might can imagine. It was a really cool place to visit.
Yeah, it's been a long time since I've been to Washington, D.C. We went for a school trip when I was very young. I was probably 11 or 12 years old, and I think that's the last time I've been out there. But I definitely would love to go back and be able to soak up some of the history and culture nowadays.
Yeah. I was old enough to appreciate it. So
what's that?
I was old enough to appreciate it when I went.
Yeah, exactly. Yeah. At that young age, a lot of it just goes over your head, doesn't it? Yeah. All right. And so Shelley, what is going to be the best way for our listeners to reach you?
So I'm online. I've got a website, loansbyshelleyr.com. I'm sure in the comments on my personal information will be in there as far as my phone number. Do you want me to give my phone number? I can, but that's the best way to get a hold of me. You can apply online there. I can all my contact information is there, and I'll tell you, I'm happy to answer questions. If somebody just has, even if you're not working with me and you want to know how something works or if something should work, I am happy to give my opinion or advice on your personal situation. So I enjoy answering those kinds of questions.
Awesome. Well, Shelley, thank you so much for your time and for your service to the community. We definitely appreciate everything that you've done for us and our clients, and I'm sure that everybody that you work with would have all the same raving reviews. So thank you so much for taking the time to speak to our listeners today about all this information. We really are super happy to have you on today, and thank you all of our listeners for taking the time to enjoy the episode. If there's anything else that you want to hear about, we'd love to hear comments, reviews. Let us know what you want us to talk about next. And we hope you all have a great week. Thanks again for tuning into the Chappell Real Estate Show. We'll see you guys soon.
Thanks for having me.
Thank you for joining us this week on the Chappell Real Estate Show. If you enjoyed this episode, share it with a friend and leave us a review. Find us on social media at Chappell Realty Group and online at chappellrealtygroup.com. Until next time.